Guys, hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. Today, got another stock analysis, something that has an opportunity that's come up, in my opinion, fairly recently due to the recent sell-off. It's one of the most interesting and yet unknown macro trends unfolding, particularly if you're a commodity aficionado like myself. And it's, for once, something that doesn't have anything to do with the eToro portfolio. So I'm going to be talking about Metals X Limited today and talking about the metal that could take everyone by surprise that nobody is talking about. And so we're talking about the forgotten metal. What is that? I'm talking about tin, SN, stannum in Latin. Demand for tin is set to grow at above 2.5% CAGRs over the next 5 years. We'll talk about the demand story. A little bit different. Normally, I like to look at the supply. This is very much a demand story with a supply that is shrinking and tenuous at best, with a bit of a dark horse that could upset the apple cart. So precisely while supply is the tightest it's been in a long time, so right now it's very, very tight. There are some people out there saying that more supply is likely to come online from, I believe, Indonesia. I really don't know about that, given some of the problems that Indonesia's had, but it's something to bear in mind for sure. Existing supply, this is the real issue. The existing supply mainly resides in high-risk jurisdictions. Okay, the safest of them all is, in my opinion, the mine that Metal X have a 50% stake in, which is in Tasmania. Although today, being in Australia, the Queensland government literally just jacked up their royalty on Whitehaven Coal, which is another company that I'm interested in terms of their coal production. So in the middle of an energy crisis, and the government wants to steal energy from potentially senior citizens and old ladies and make it more expensive. There you go. But hey, it's going to discourage demand, because now investors and other producers around the traps are just finding it that much harder to invest. Anyway, we need, and we'll continue to need more and more tin, particularly for all sorts of different things. Mainly, I believe it's a battery play in order to get the most out of the batteries. And if you are a believer in the electrification theme, particularly around electric vehicles, we're going to need more and more tin as things start to unfold. Literally no one talks about tin. Like no one, or one or two people that I know of have talked about tin. It's just insanely underrated as a commodity. And if you've been watching the price action over the last 2 years, it's gone almost parabolic. It's gone insane. As I look out on capital markets now, there are only really two viable options, two main producers in which you can get exposure to tin. And one of those is in the DRC, okay, Democratic Republic of Congo, for those of you not sure about the acronym. So that carries with it obviously a whole heap of risk. The other one resides in Australia. That's the one we're going to talk about today. So a quick note on supply. There's lots and lots that you can read. You can go onto the ITA, the International Tin Association. They have some good stuff there. But in a nutshell, this is the same kind of theme that you've no doubt heard me speak a lot about when it comes to commodities. Tin, it seems, is no exception. If you've got the production versus the demand growth, that green area is the gap, is a supply shortfall. Okay, so unless something out of the blue happens, when you've got growing demand and stagnating, call it stagnating supply, the relief from which is the price. The price has to go up. People need tin, they need to be able to buy it. There's not enough of it around. And so it starts to put a floor under the price, and slowly that floor, well, not slowly in tin's case, it's been moving quite quickly underneath the spot price. On the demand side, this really blew me away. It was quite surprising. When we think about metals, particularly electrification and batteries, we think copper, silver, lithium, nickel, cobalt, all those sorts of things. And indeed, that for good reasons, investors are really keen on the copper outlook over the next decade to 2 decades, because we've got bugger all supply, and we're going to have a whole heap of copper demand for the electrification theme. It's another reason why I happen to like steel. In any case, if you look at the impact of the new technologies coming onto the market, tin is actually the number one metal which is affected by this. It's very, very interesting. Looking at the tin demand graph down the bottom here, it only goes up to 2018, but it's kind of like this Chevron's paradox where technology is getting more efficient, let's say, at least up until now. It may change with the deglobalization of supply chains. We'll see. But if you have more efficient technology and you can use it with less material, normally you expect the price of that material to decrease. However, oftentimes what we find is a proliferation of new technologies that use that material. And so they may use less of it per unit, but in the aggregate, demand for the particular material starts to rise. And so that's Chevron's paradox. It will be interesting to see if that applies to tin. And I think it may well. Here's the price action that I was alluding to earlier. And as you can see, a spike in the last commodity cycle, then we went kind of nowhere. And then it just went absolutely vertical in the latter stage of 2020, call it the start of 2021. We've since had a cooling off in the price. And we will see. 1 year of that is not enough to bring extra demand on the market. You can't just open a tin mine like that. Tin exposure, tin production outside of the DRC and Alphaman's the huge and high grade deposit there. You're mainly talking Myanmar and China. Myanmar, China, Indonesia a little bit, and then obviously the Metals X project in Tasmania. So you can't just turn on the tap in terms of increasing tin demand. And Myanmar's a very unstable jurisdiction as it is, and they have lots of problems with weather like landslides and floods and that sort of thing. So it doesn't take much to disrupt the tin market. It's highly volatile. So that leaves us with, okay, well, how do you get access to this thing? You don't want to invest in the Congo. I do own, for disclosure, I do own some shares in Alphaman. It's a tiny amount, guys. I think that the Chinese will end up buying that out. And so the next option really, as far as I'm aware, is Metals X. I don't know of another one. There is a junior that I believe have a deposit that they're trying to develop, but nothing else that is in production would I consider a viable option. It's Alphaman or Metals X, and that's it. Aussie producer owns 50% stake at Renison tin mine down in Tassie, 120,000 tons of proven and probable. And so that at their current production rate, that's around about 14 years of reserves, there or thereabouts. 52% free cash flow margin in Q1 at the current tin price. So obviously a huge amount of that of sales are dropping straight to the bottom line. The current tin price suggests roughly about a 60% IRR, depending on how you track that out. And obviously it wouldn't be prudent to necessarily assume that we're going to have the same elevated tin prices moving forwards. You've got around about 30% of the current market cap in cash. Okay, so I'll go over the quarterlies in a second, and you'll see that I believe they closed at around, if I remember, 91.4 million in cash, which, as I said, is about a third of the market cap. So if you're paying 38 cents, which is the closing price today at time of recording, you're getting roughly a little bit more than 10 cents of that in pure cash on the balance sheet. I was lucky. I actually have owned Metals X for a while, and I received free shares in their nickel cobalt spin-off. So they did have a deposit there. They decided to spin that off, and shareholders in Metals X, you'll know that you received a pro rata amount of shares, whatever your entitlement was. If we take a look at the price action, okay, as you can see from about 5 years ago, we've dropped down. There would have been a little bit of dilution, no doubt. I haven't checked it, but I purely assume that there was. There may not have been. And we had that massive run up following the tin market. And then we're back down to roughly September of last year. So here we go. I've added in some key points. This thick blue line here is the 200-day moving average. As you can see, we're coming down and kissing that 200-day moving average. So it's a great time to buy Metals X at the same price, okay, as you could have in September 2021. If you're interested. And it'll be interesting to see if we do get further selling pressure, it might stay down in the doldrums. You can see there's quite a bit of volume in the red there of selling pressure. I believe that's people basically selling off broadly and indiscriminately, thanks to the crypto markets plummeting over the last 2 weeks. On RSI, I've just drawn a little red line there to draw your attention towards the RSI. We're down right on the 30 line, which means that selling momentum is starting to slow. And so we would expect that to expect the price, at least on a technical basis, to have a little bit more support moving forward. But we shall see. I don't make a lot of decisions, or I don't make any decisions based on technicals. I just use it to form a broader picture. So Q1 2022, here you can see the ore, the grade. It's not as good as Alphaman, but then again, the Congo is just such a rich territory. You often find some amazing deposits there. And so here we go all the way down to realized prices in Aussie dollars. Okay, so just drawing your attention to that, you'll need to be aware of the conversion. If we see a strengthening in the Aussie dollar, which we might, it'll be interesting to see which way that goes, because if they're selling onto the open market in Aussie dollars and their overheads are all in Aussie dollars because the mine is based in Tasmania, you would think that it shouldn't make too much of a difference. If they were to be able to sell in a different currency, then obviously then you would have difference between the two. AISC, or the all-in costs, so around the 23 mark. So you can see they have a healthy margin there. Like really, all-in sustaining cost, depending on who you listen to, depending on what metric you want to use, the idea of that is that takes into account every single dollar in expenses of the company, which should include capex and cost of reproduction in the future, and and then divided by the number of tons. So how much does all the expenses cost on a per ton basis, in this case, per unit? Gold companies use per ounce, right? And then you can see here, this is what they're selling tin up for per ton, and this is what it's costing them per ton to produce, in theory. Sometimes these numbers can get a little funky. If you look at their cash produced down here, second from bottom, per quarter, that works out to be 52% of their imputed revenue. Okay, so that's where you're getting that free cash flow margin from. Obviously, that will change, or that will fluctuate with the tin price. So you'll need to bear that in mind. If you're building out a model, you'll need to decide what you think the tin price is going to be. You would not be able, in this case, to model out the revenues and then just assume that 52% of that will drop to the bottom line, because it won't work that way with commodities, guys, because the underlying will fluctuate, whereas the expenses are fixed. Okay, that's the trick with these types of businesses. Okay, and put myself a little note here to show you into some of my modeling. So here are the assumptions for Metals X. I have given them a 0% growth rate, perpetual growth rate. Why do I do that? Because it's not a business like a bank, or it's not a business like an insurance company. This is a deposit, and every time you generate cash from the deposit from selling, in this case the tin, you're depleting your deposit. So we think of it more on a net asset value base, where eventually that asset is going to deplete fully, and so I give them zero credit in perpetuity. It's a small difference, but I thought I might make that clear. Some people might ask. Multiples, I'm using a 6x multiple. This is a company that has a net cash position. Okay, so they're in a very good position. This is a company that has a great deposit, or an interest in a great deposit. It has really a monopoly in some sense on tin. I know it's not the only tin producer in the world, but in terms of an investable option in tin, you really have Metals X and you have Alphaman, which is likely going to be sold to the Chinese. And Alphaman is in the Congo, and Alphaman you're paying sort of 4 times book value, whereas here you're paying like 1 and a bit, if that. So I really think that 6 is not unreasonable to use for this particular company. Shares, debt, cash, that's all on the balance sheet, right? No explanation really needed there. If you look further down here, this is a very crude model, and this allows you to see what happens when the tin price changes. So you've got their expected production, okay? And then you've got the 50% interest, because they only own half of the mine, right? So they're entitled to half of the cash flows. So then we look at the all-in sustaining costs and you get a margin. This is per quarter. And so I have extrapolated that out for the rest of the year. And that has gone into the EBIT. And then you add back non-cash expenses, okay? I don't know what they've put in the all-in sustaining costs. So you might argue, well, actually, you don't need to then further add in some of these other things because do they account for CapEx in the AISC? That's another argument. To be on the safe side, you can do it, or you could strip that out and go with just the all-in sustaining cost. Up to you. If I use a tin price of 35,000, which would be roughly 23,000 per ton in US dollars at the current exchange rate, we get more towards the 58. So you can put that into the model and you can see what happens. Okay, I'm using a 20% discount rate as I like to do, and it does change things quite a bit. Okay, you're still getting a good equity value per share because of the cash in the balance sheet, but you can see how that changes just with the changing of the tin price, assuming that they keep production flat. Obviously, they may look to increase. They've said that they believe they can increase production at 10% and decrease expenses. So obviously you should have a widening margin. So that would be a really bearish case, I believe, in which case, if you're looking for 20% on investment, you're right around fair value, okay? All other things being considered, whether you want to argue that you get a 10 times multiple could easily be the case moving forwards. Absolutely. You can play around with those sorts of things. But I just wanted to show you what can happen when you start to model out commodities. It's a little different because all of a sudden your cash changes, your revenue changes, whereas your expenses are fixed. Okay, excellent in an uptrend and then terrible in a downtrend. Okay, so the verdict is, for me, I'm accumulating. If it drops below 30 cents, I'll really accumulate aggressively. I would like it to get maybe 2 to 3% of assets under management. Again, not any eToro, it's my ARB fund, but it's a company that is a net cash position. That's not an issue. You've got margin of safety. You have sales growth, like 52% free cash margins in the current tin environment. Yes, that will change likely, but maybe not for the worst. Maybe we get in a real crunch and tin goes through the moon, gets up to around 50K. I don't know, it could happen. And share buybacks, I believe they will buy back more shares. The company, the management have a history of creating value for shareholders via spin-offs, and that's a very good sign. That's all for today. I hope you enjoyed it. If you haven't already liked and subscribed, I would greatly appreciate you doing so. And if you're looking for value investor on eToro, you can follow the fund by downloading eToro app and copying the link there. You can add funds if you're ready to add funds, or you can just keep an eye on us and see what we're up to. Disclaimer, of course, nothing in this is to be considered financial advice. It's just my opinion and my estimates. Can't make any guarantees to the accuracy of the information. It's just, for me, this is an entertainment outlet for me to put out my thoughts. Doesn't mean that they're right, and doesn't mean that what I do is necessarily right for you. So this is just what I'm doing. You need to be responsible for your own decisions and not confuse any of this as advice. Having said that,